If you've been gauging the severity of the war in Iran by just looking at the S&P 500, you'd be forgiven for thinking that the whole thing is just a minor administrative hurdle, the kind that clears up after a weekend of strongly worded tweets. Equity investors, it would appear, have decided that a regional conflict might just be a buy-the-dip opportunity. That calm finally broke on Thursday, when stocks had their worst day since the conflict began, with the S&P 500 sliding to a six-month low, and the tech-heavy Nasdaq officially crossing into a technical correction, meaning that it's more than 10% below its high. The mood on the bond and commodity desks remains grim. Analysts there are staring at their screens in a state of what one commentator called alarming cognitive dissonance. In the bond market, the term premium, effectively the insurance premium investors charge for holding long-term debt, is surging. Robert Armstrong noted this week that while 10-year interest rates have gone up, break-even inflation has stayed relatively flat. This suggests that investors aren't just worried about inflation, they're worried that in a world of supply shocks, bonds no longer act as a good hedge for stocks. They simply both fall at the same time. In the UK, 30-year gilt yields have climbed to 5.5% as the Bank of England faces a central banker's nightmare, an energy shock that raises inflation while killing growth. This divergence is being driven by a new Wall Street obsession, the Trump Pressure Index. Developed by Deutsche Bank's head of cross-asset strategy, the index is made up of the one-month change in Trump's approval ratings, one-year inflation expectations, the performance of the S&P 500, and U.S. Treasury yields. The idea is that these are the things that Trump cares the most about. Sorry, Eric, but you just didn't make the list. The higher the index goes, the more pressure Trump is under to make a change to his strategy in Iran. Traders are using this to predict when the administration will experience what Robert Armstrong calls a taco moment. The acronym, coined about a year ago, stands for Trump Always Chickens Out. We saw this play out in real time on Thursday. Just 11 minutes after the closing bell, the president posted a 10-day extension to his peace deadline, pausing his threats to destroy Iranian energy plants until April 6th. Now, we have to ask ourselves, do stock traders actually believe these announcements? A few weeks ago, the president announced that the war was very complete, pretty much, causing stocks to rise and oil to fall. Those moves reversed themselves later as events in the Middle East dragged on. Earlier this week, Trump announced that the US and Iran had held very good and productive conversations about ending war, once again causing stocks to rise and oil to fall, even though Iranian leaders quickly came out and denied having any talks. I'm not sure that traders actually believe these peace announcements, but they possibly see the announcements as a signal that the president's resolve is weakening. They aren't buying the peace so much as they're buying the capitulation. But a possible problem with that is that you can't necessarily taco out of an actual war as easily as you can a trade war. Unlike a trade dispute, which is a matter of administrative ink, the Strait of Hormuz is currently governed by mines and broken infrastructure. Even if a ceasefire was signed tomorrow, oil wells can't just be turned back on like a kitchen tap. It takes weeks to bring them back online without causing permanent damage. But even if Trump does blink, negotiating a deal assumes that there's a credible leader on the other side of the table, and the war has left Iran's command and control in total disarray. As the saying goes, it takes two to taco, or at least I think that is what the saying is. Senior officials in Iran are reportedly underground and avoiding all electronic communications for fear of targeted assassinations. It's not clear if any single diplomat in Tehran actually speaks for the Revolutionary Guards, the people who actually have their fingers on the buttons. A formal agreement signed in a safe house may have little effect on a field commander at a remote missile site who's either unable to receive orders or simply doesn't respect the authority of the person who sent them. Today we're going to look at why this crisis is about much more than just the price of Brent crude, and how the global economy may be approaching a supply cliff that no Truth Social post can fix. We'll look at the single points of failure for global industry, commodities like helium, LNG, aluminium, and fertilizer that have no easy alternative routes. We'll also discuss the winners and losers of this new reality and why the physical damage to the region's infrastructure means that we'll likely be living with the fallout of this war long after the shooting stops. Before we dig into that, though, let me tell you about this week's video sponsor, Incogni. Most people don't realize how much of their personal information is exposed online until they see it for themselves. A quick Google search of your name, city, and state will often find dozens of websites listing your personal details, like your address, phone number, email, and relatives' names, usually without your consent. That's information that can be bought by anyone with an internet connection. Incogni is a service that works to remove that information from the internet. One thing that really sets Incogni apart from the competition is their custom removals feature, available on their unlimited plans. This goes way beyond automated tools. If you find a specific website, a blog post, or a forum that's displaying your personal information, you don't have to fight them yourself. You simply send the link to Incogni, and your dedicated privacy expert handles the entire removal process for you. It's like having an online bodyguard scrubbing your name from the corners of the web that automated tools sometimes miss. Take back control and protect your online privacy. Go to incogni.com/Boyle by clicking the link in the description and use the code Boyle to get 60% off an annual plan. There's a money-back guarantee if you aren't satisfied. Now, while much of the general news coverage is quite rightly focused on the military conflict and the human cost of the war, the financial headlines have focused almost exclusively on the price of oil. And this is understandable because it's the source of the region's immense wealth. But if you're only watching the price of a barrel of Brent crude, which hit $110 this morning, you're likely missing the real story. Oil, for all of its importance, is a relatively fungible commodity. If a shipment is blocked in the Gulf, you can eventually find another barrel in West Texas, Guyana, or the North Sea, provided you're willing to pay up for it. The real crisis is to be found in commodities that are much harder to replace. According to ship tracking data, we're currently approaching a cliff edge as the final LNG tankers that loaded in the Gulf before the blockade began are due to reach their destinations in the next few days. Once those ships are unloaded, the flow of these commodities essentially stops. Qatar produces a fifth of the world's liquefied natural gas, and nearly all of its exports have been halted by the closure of the Strait of Hormuz. Unlike oil, LNG requires massive specialized liquefaction plants to turn gas into liquid for transport. The Ras Laffan facility in Qatar has already suffered enormous damage from Iranian missile strikes. The Qatari energy minister has warned that 17% of their capacity will be out of service for 3 to 5 years, forcing them to declare force majeure on long-term contracts. This is a hole in the global energy supply that no amount of diplomatic pressure can fill. Then there's helium. Around 33% of global seaborne helium passes through the Strait of Hormuz. Helium is a non-renewable byproduct of natural gas, and it's essential for cooling the supermagnets used in manufacturing semiconductor chips. There's no synthetic substitute, and for high-tech manufacturing hubs in Asia and the US, there's no easy way to reroute the supply. We also have to consider fertilizer and aluminium. 1/3 of the world's seaborne fertilizer trade passes through the strait, along with 1/4 of the world's seaborne aluminium. Since the US and Israel launched their strikes, including a fresh wave of strikes on Tehran this morning, the price of nitrogen-based fertilizer has skyrocketed. This happened right as farmers in the Northern Hemisphere are heading into springtime when they fertilize their fields. This is a lurking threat to food security. As UAE Minister Sultan Al-Jaber put it this week, Iran holds Hormuz hostage and every nation pays the ransom at the grocery store. If farmers in Asia and Africa can't fertilize their crops this spring, the World Food Programme warns that we could see record levels of acute hunger by 2027. These are the single points of failure in our modern supply chain. The optimism that we see in the stock market relies on the idea that these are temporary hitches. But with Iran now asserting sovereignty over the strait and reportedly demanding a $2 million fee for every vessel that wants to pass, the physical reality suggests that we're moving into an era of scarcity that a simple ceasefire won't fix. Even if a breakthrough is reached by Trump's new April 6 deadline, the immediate relief rally we'll likely see in the stock market will be at odds with the reality on the water. To understand why, we have to look at 3 specific bottlenecks that a peace treaty cannot simply wish away. First, there's the problem of the shut-in wells. Because the Strait of Hormuz has essentially been blocked for a month, Gulf producers were forced to stop pumping as their storage tanks hit their limits. This is a much bigger problem than just pausing a production line. When you stop the flow of an oil well, the environment inside that well changes immediately. Without the constant heat and the movement of flowing oil, the crude starts to settle and separate. It can become waxy and thick, physically clogging the tiny pores in the rock that the oil needs to travel through. In some cases, the surrounding groundwater can even seep into the oil layers, which can permanently drown a well's productivity. To make matters worse, many of these wells will have been closed using heavy mud or cement plugs, which are needed to keep them safe during the fighting. Those plugs will have to be painstakingly drilled out before any oil can move again. If you try and force the pressure back too quickly, you risk cracking the underground formations and ruining the field forever. It's a delicate multi-month restart process that doesn't just happen overnight. The second hurdle is the naval gauntlet. While the US and Israel have spent a month bombing Iran, they've achieved almost no substantive gains in loosening Iran's chokehold on the strait. This is why the Pentagon is currently sending in 10,000 additional troops, including units trained to seize and hold land. Their mission appears to be prying the strait open by force, physically taking the islands and coastal slivers where Iran hides the drones and missiles that are keeping the American Navy at a distance. Even after those launch sites are secured, the waterway remains at the very least a suspected minefield. Whether or not Iran has actually laid thousands of mines, the mere risk of them creates what experts call a psychological blockade, which is just as effective as a physical one. Reopening the strait safely requires a careful naval operation, first hunting down any remaining threats like speedboats and drones that have been harassing shipping, followed by the slow, painstaking process of sweeping the water for mines. Only then can the final phase, providing continuous naval escorts for commercial tankers, actually begin. Finally, there's the logistical logjam. Traffic through the strait has dropped by 97% this month. The few ships that are moving are often dark fleet vessels, or those willing to pay the $2 million safe passage fee that Iran is currently demanding. Insurance premiums for the region haven't just spiked. In many cases, policies have been cancelled entirely. Ship captains and their crews are not going to steam back into a recently cleared war zone the moment a Truth Social tweet goes out. They'll wait for a sustained all clear from naval authorities and for the insurance markets to normalize. When you combine all of these issues, the Oxford Economics timeline of the Strait remaining largely impassable until May starts to look very realistic. Whenever a crisis like this breaks out, economists are quick to point out one comforting statistic. Our oil intensity has collapsed. In the 1970s, it took roughly 1 full barrel of oil to produce $1,000 of global GDP. Today, that number is less than half. We need only about 0.4 barrels to generate the same amount of economic output. The argument is that because we're more efficient, we're no longer the hostages to the Middle East that we were 50 years ago. But this is a dangerous distraction. While we've moved away from oil as a primary fuel for factories and home heating, we haven't actually reduced our energy vulnerability. We've simply transferred it to the power grid. In much of the world, electricity prices are set at the margin by natural gas-fired power plants. So when the Strait closes and 20% of the world's LNG vanishes, the shock doesn't just hit the gas pump, it hits electrical sockets too. And this is where the modern US economy has a weakness that didn't exist in the 1970s, the AI revolution. Right now, we're near the start of what's being described as the largest infrastructure build-out in human history, centered entirely on hyperscale data centers. These facilities are essentially giant energy sinks that require massive steady-state power to function. To understand the scale, analysts look at these facilities in terms of gigawatts. 1 gigawatt is enough power to run a mid-sized city or about 750,000 homes. The International Energy Agency predicts that by 2030, the global demand from these data centers will grow by an additional 50 gigawatts. To put that in perspective, the electricity needed just to keep the world's AI chips running in 4 years' time is expected to be equivalent to the total power consumption of Germany and France combined, or roughly 3.5 times the total power consumption of the UK. These projects represent hundreds of billions of dollars in capital investment, and the United States appears to be pinning its expected growth in the coming years on AI build-out. An energy shock today would likely be very different to the 1970s, where there were long lines at gas stations, but it's not reasonable to claim that energy scarcity won't impact growth. In the world of geopolitics, winning doesn't always involve having the best military. Sometimes it just means being the last person to run out of somebody else's money. The terms winner and loser often have very little to do with whose cities are being bombed and everything to do with relative strategic advantage. If we look at the scorecard for this conflict, the results are surprising and deeply counterintuitive. It's difficult to call a country a winner when its air defenses are in pieces and its leadership is hiding in bunkers to avoid assassination. So the best we can say for Iran is that it's a survivor. But as The Economist argues, for the Islamic Republic, mere survival against the combined might of the US and Israel counts as a victory of sorts. Iran has successfully demonstrated that it can hold the global economy hostage using nothing more than asymmetric tools, cheap drones, missiles, and the credible threat of underwater mines. Most strikingly, in a move that highlights just how desperate the global energy situation has become, the US appears to have quietly retreated on its own sanctions. Despite being in an active shooting war with Tehran, the Trump administration has temporarily waived sanctions on 140 million barrels of Iranian oil currently at sea because the supply shock from the Strait's closure is so painful that the White House cannot afford to keep those 1.5 million barrels a day off the market. While Gulf allies watch their own tankers sit idle, Iran is currently getting its crude to China and is now attempting to institutionalize a $2 million safe passage fee for non-hostile vessels. If they can make this stick, they could generate up to $80 billion a year, effectively replacing their lost oil revenue with a global transit tax. Russia is perhaps the most unambiguous winner of the crisis. Not only are soaring oil and gas prices relieving its previously strained budget, but it has now received its own sanctions holiday. On March 13th, the U.S. Treasury lifted restrictions on Russian oil tankers currently at sea to prevent a global supply shock. This move has achieved two of Moscow's primary strategic goals. It provides an immediate cash infusion to its war effort in Ukraine, and it has triggered a bipartisan revolt in the U.S. Congress, with lawmakers like Chuck Schumer labeling the policy asinine. By forcing the U.S. to choose between energy security and its foreign policy goals, Russia has successfully exposed the limits of American economic warfare. China occupies a fascinating and arguably enviable position. While it's the world's largest oil importer, it's now roughly 85% energy self-sufficient, thanks to its massive domestic coal reserves and an aggressive multi-year pivot to renewables. The upside for Beijing is that this oil shock is the best possible advert for Chinese technology, as the world may speed up its transition to solar panels, batteries, and EVs, industries that China absolutely dominates. While Netanyahu may be thrilled with the tactical success of the strikes, the strategic reality for Israel is much bleaker. Despite the bombardment of their enemy, Israel is not really any safer than before. Iranian missiles have still penetrated Israeli airspace, and the nuclear threat remains buried under rubble. Furthermore, the war is severely straining Israel's relationship with its most important patron. As U.S. gasoline prices soar and markets slide, American voters are increasingly pointing the finger at the cost of supporting the conflict. Europe is currently facing what analysts call its second major energy crisis. With Qatari LNG completely cut off and domestic gas storage at a dangerously low 30% capacity, electricity surcharges of up to 30% are hitting heavy industry, leading to fears of permanent deindustrialization. The real shock to Europe isn't just economic. On March 20th, Iran fired two ballistic missiles at the US-UK base at Diego Garcia. This strike demonstrated a range of 4,000 kilometers, twice Iran's previously known capability. This means that every major European capital is within direct reach of Iranian missiles. If you want to find the G20's biggest loser, you don't have to look much further than the United Kingdom. Because of its extreme dependence on imported natural gas, the UK is facing what Kenneth Rogoff calls the biggest stagflationary shock in 5 decades. The damage is appearing in real time. The rout in the gilt market has pushed 10-year borrowing costs to their highest level since 2008, forcing lenders to withdraw over 1,500 mortgage products from the market in a single month. Finally, there's the United States. On paper, the US is a winner. Its energy independence and status as a major LNG exporter have provided a massive windfall for domestic producers. But, according to the FT, this insulation is something of a mirage. And the reason comes down to what economists call embedded energy. The US runs a massive trade deficit in manufactured goods, and it takes an enormous amount of energy to produce those goods in factories across Asia and Europe. When energy costs for those global manufacturers skyrocket, those costs are eventually exported to the US in the form of higher prices for everything from electronics to clothing. The American grocery bill is also directly in the crosshairs. Because the US agricultural system is so heavily dependent on fossil fuels for both fuel and nitrogen-based fertilizers, the energy shock in the Gulf translates almost immediately into higher prices for bread, meat, and dairy. This imported inflation has forced a radical shift at the Federal Reserve. This brings us back to the Trump Pressure Index. The president's political survival is tethered to the returns of the S&P 500, inflation, and the price at the pump. By making a big threat and then backing down the moment markets panicked, the administration has signaled to every adversary on Earth that the fastest way to defeat a superpower is to strike its retirement portfolios. I'm recording this video right before the market opens on Friday, and S&P futures are down almost 0.5% in the overnight market, and it's possible that markets are no longer giving the president the benefit of the doubt that his strategy in Iran is working. Beyond the major powers, the conflict is triggering a form of energy triage that's fundamentally reshaping daily life around the world. We have to start with the United Arab Emirates and the potential end of what we might call the Dubai dream. For decades, Dubai has branded itself as a neutral, high-luxury oasis, a Singapore of the sands where you could do global business while the rest of the Middle East was in turmoil. But that brand is currently being shattered. Since Iran began its retaliation on February 28th, the city has transformed from a billionaire's playground into a ghost town in just 3 weeks. The problem is demographic. Over 90% of Dubai's population is foreign-born. When you don't have deep roots in a location, stability isn't a luxury, it's the entire product. The mobile elite have already hit the exit. We've seen reports that the hedge fund Millennium Management is exploring a relocation of its Dubai-based staff to Jersey after drone debris reportedly damaged the building housing their offices, which leaves us wondering if Andrew Tate will soon be the only person left on the Palm Jumeirah. While wealthy expats might flee to tax-neutral islands in the English Channel, the rest of the world is entering a period of energy rationing. Governments almost entirely dependent on Middle Eastern energy are racing to save what little they have left. In Thailand, the Prime Minister has ordered civil servants to take the stairs instead of elevators to save power. In the Philippines, the government has shifted to a 4-day work week and ordered offices to switch off computers during lunch breaks. This rationing highlights a brutal divide. While wealthy nations like the US and the UK can use massive subsidies to shield their citizens from the worst of the price hikes, they are inadvertently suffocating everyone else. By artificially keeping domestic demand high, rich countries block the price signal that would normally force a drop in consumption. This leaves the world's poorest nations to bear the full brunt of the scarcity. In Bangladesh, universities have been closed, and in Pakistan and India, the gas shortage is so acute that families are being issued half-filled cylinders of cooking gas. Shortages aren't just happening in poor countries either. A Japanese potato chip company had to halt production this week due to a shortage of oil, which is a relatively minor inconvenience in Japan. But if deep fryers went dark somewhere like Scotland, where people have evolved to subsist entirely on deep-fried food, it could cause a genuine famine. As we approach the next deadline on April 6th, the temptation is to believe that a deal will return everything to the status quo, but the logistics of oil and gas may not be so easily appeased. Even if a deal is signed tomorrow, the economic fallout from this conflict will likely be felt well into next winter, and possibly for years beyond. This crisis has highlighted something that we've also been seeing in Ukraine, that you don't need a peer-level military to defeat a superpower. By holding the global economy hostage, Iran has shown that asymmetric disruption is just as effective as traditional warfare in achieving your goals. The fact that the US has been forced to ease sanctions on its enemies is the ultimate proof that in the modern world, the market is a more sensitive target than any military base. The second shift is the end of the idea of security by distance. For decades, Europe viewed Middle Eastern volatility as a tragic but distant problem. The breakthrough of the 4,000-kilometer missile has ended that luxury. Every European capital is now within reach of a power that has proven it's willing to strike whomever it needs to get its way. Ultimately, a negotiated de-escalation might provide a sigh of relief, but it can't weld the turbines back together at Ras Laffan, and it can't erase the new reality of fragmented alliances, where energy security has replaced ideology as the ultimate geopolitical currency. The stock market might be buying the peace trade today, but the physical world moves at its own pace, dictated by ships, pipes, and turbines rather than sentiment. If you found this video interesting, you should watch my video on China's rare earth chokehold next. Don't forget to check out our sponsor Incogni using the link in the video description, and see you in the next video. Bye.